You know, when we think about Warren Buffett, we picture these brilliant, genius-level investment wins. But what if the real secret to his success isn't about what he did, but what he didn't do? Today, we're going to flip the script. We're distilling decades of his wisdom into a super powerful guide on avoiding the biggest mistakes out there. Because in investing, winning is often just about not losing. So what's the secret sauce, right? What really separates legends like Buffett and his partner Charlie Munger from, from everyone else? You might think it's about making these incredibly complex, once-in-a-lifetime moves, but the truth is actually way simpler and honestly way more achievable for the rest of us. And there it is. That's the core philosophy. It's not about playing offense, it's all about defense. Look, superior returns don't usually come from hitting grand slams. They come from the simple, disciplined act of not making huge errors. If you can just sidestep the big blunders that trip up most people, you're already way ahead of the game. To make this really easy to digest, we've broken down these 12 mistakes into 3 main categories. First up, we're going to tackle the internal battles, the mistakes of the mind. Then we'll look at some seriously flawed frameworks with mistakes in your strategy. And finally, we'll cover the practical, hands-on errors in mistakes in your actions. Okay, let's start with the toughest battlefield there is, the one right inside our own heads. These are the psychological traps, the emotional biases that are basically hardwired into our brains, making us our own worst enemies when it comes to money. First up is a huge one, confirmation bias. It works like this. We fall in love with an idea, say that a certain stock is a guaranteed winner, and then our brain just starts filtering reality to fit that belief. We start looking for anything that confirms we're right, and we subconsciously ignore all the warning signs that say we might be wrong. It's like putting on blinders, and it is so dangerous. Charlie Munger had this amazing analogy for it. He said the human mind is like a human egg. So step 1, an idea gets in. Then, just like with an egg, step 2, the mind immediately shuts the door behind it. And that leads to step 3. Any new information that contradicts that first idea just gets blocked. It can't get in. It's a perfect explanation for why it's so hard to change our minds, even when the facts are screaming at us. This leads us right into the next mistake, following the herd. It feels safe, right? Doing what everyone else is doing. But as the legendary investor Howard Marks says, if an investment idea is obvious and popular, the price probably already reflects all the good news. The real opportunities are usually found where the crowd isn't looking. Now, for our third mental mistake, let's look at a quick story. You've got 3 different investors, Arnold, Ben, and Katie, who all own the exact same stock, Amazon. Arnold's up a little, Ben is down a lot, and Katie has more than doubled her money. So here's the question. Should the price they each paid in the past have any impact on their decision to buy, sell, or hold that stock today? The answer is a hard no. It shouldn't matter one bit. The stock has no clue what you paid for it. Arnold's small gain and Ben's big loss, that's what's called a sunk cost. It's in the past, it's irrelevant. The only question that matters for all 3 of them is what is this business likely to do from this day forward? Getting emotionally attached to your entry price is just a recipe for disaster. Okay, so we've talked about the mind. Now let's move on to the map. This is part 2, mistakes in your strategy. This is all about the flawed ways of thinking and the broken analytical models that can lead even really smart people down the wrong path. A classic mistake here is trying to time the market. Trying to predict recessions or what the Fed's going to do with interest rates. Buffett completely avoids this game by using a simple 2-part filter. He only focuses on things that are both important and knowable. So, is the direction of the stock market important? Of course. Is it knowable? Absolutely not. But is the quality of a specific company knowable? Yeah, to a large extent it is. And that's where you should spend your energy. 1 in 10. Just look at that number. Seems pretty low, doesn't it? What do you think that represents in the investing world? That's it. That is the tiny fraction of large U.S. companies that have actually achieved that super high growth that so many people build their entire investment cases on. This shows you the massive danger of making aggressive growth projections. When a stock's price is counting on it growing at 15 or 20% a year, you're not really investing. You're just betting on a 1 in 10 long shot. All right, here's another one that really goes against the grain. What Buffett calls jumping over 7-foot bars. In most parts of life, like sports or science, tackling the hardest problems gets you the biggest rewards. But in investing, it's the exact opposite. Complexity usually just adds risk. You get 0 extra points for buying a business that's incredibly difficult to understand. Just stick to the 1-foot bars you can easily step over. So, if we're supposed to avoid the complex stuff, what should we focus on? To avoid missing the forest for the trees, Buffett boils it all down to just 3 things. 1. Can you understand the future of the business? 2. Can you trust the people running it? And 3. Are you paying a fair price? That's it. Master those 3, and everything else is just noise. Okay, on to our final section, mistakes in your actions. This is where the rubber really meets the road. We're talking about the tangible errors that people make when they actually start clicking the buy and sell buttons. Let's talk about a mistake that is like playing with financial dynamite, using way too much leverage or borrowed money. Meet Harry. He was a hedge fund manager who was totally convinced that GameStop stock was overvalued. And you know what? In the long run, he was probably right. But because he used leverage, the market's short-term craziness forced his hand. He got margin called and had to sell for a massive loss. Leverage takes control away from you. You can be 100% right on the facts and still go completely broke. And that leads perfectly into our next mistake, feeling like you have to be busy all the time. Investing is not a job where more activity leads to better results. Buffett compares it to being a baseball batter, but with one amazing twist. You get unlimited strikes. You don't have to swing at every pitch. You can just stand there and wait for that perfect, slow, fat pitch right down the middle. So often, the most profitable action is doing nothing at all. Next up, we have 2 mistakes that are really just 2 sides of the same coin, shrinking your universe of ideas, and the opposite, diversifying way too much. Buffett says you have to decide what kind of investor you are. Are you a know-nothing investor? And hey, that's a perfectly smart way to be. If so, you should cast a super wide net and buy something like an index fund. But if you're a know-something investor who puts in the hard work, you should concentrate your money into your 6 to 10 absolute best ideas. Adding your 20th best idea only waters down your truly great ones. And now we've arrived at the final mistake. And according to Buffett himself, this is the biggest one of all. It's not about the bad investments you make, the mistakes of commission. It's about the great ones you don't make, the mistakes of omission, when you fail to act on an incredible opportunity that's staring you right in the face. Look at that number, $8 billion. Just let that sink in for a second. This is the cost of one of Buffett's biggest thumb-sucking moments, as he calls them. That $8 billion is the estimated profit Berkshire Hathaway missed out on with Walmart. He knew it was a phenomenal business, he was already buying it, but then the stock ticked up just a tiny bit, and he hesitated. He got anchored to that first price and waited for it to come back down. It never did. It was a massive, massive mistake of omission. So how do we defend ourselves against all this? Well, it really comes down to these 3 things. First, master your mind. Just be aware that these biases exist. Second, simplify your strategy. Focus on simple, knowable businesses. And third, act with patience. Wait for that rare, perfect opportunity, and then have the courage to swing big. And that brings us to the end. As you look back on these 12 deadly sins of investing, I want to leave you with one last question to really think about. Which one of these is your biggest blind spot? Because being honest with yourself about that's the real first step to becoming a much better investor.